Will infrastructure expenditure make the future brighter? The 2014 budget speech coverage is brought to you by Old Mutual Corporate.
Welcome back to this special edition of the National 2014 Budget Day coverage. I'm Nozi Pombanja. Joining us during this segment is Adrian Saville, Chief Investment Officer and Founder at Cannon Asset Management, and Colin Wakefield, Derivatives Specialist at RMB. This panel will take a look at the impact the budget had on the bond and equity markets. Gentlemen, thank you so much for making the time to join me today. Adrian, let's start off with you. The big question, was this a good budget for markets and investors?
In the first 20 minutes, I counted NDP about 53 times.
Yeah.
I'm not sure if it was 53 times, but the simple point that I'm trying to make is that it was very encouraging, reassuring to hear about framework consistency. And I think that that is a very reassuring aspect for capital markets.
How does that reflect against your expectations?
There weren't any big surprises, and I don't think that that is unsurprising because of the simple reason this is an election year. You're not going to get big, grand policy positions or policy shifting, or it would be unusual, certainly unexpected, to get big policy shifts in an election year. There was nothing that that sort of caught me as wow. Didn't see that coming.
No.
Fiddling around the edges.
Yeah, no wow factor for Adrian, but perhaps for you, Colin, was it a good budget for markets and investors?
As expected, as Adrian mentioned, I think the fact that it's an election year means anything that's controversial on either side of centrality will probably be pushed to after the election. Everybody's keeping a very close eye, of course, on the Davis Tax Commission, which the Minister did mention today. I think more interesting in the detail for those of us involved in the fixed income markets were details around how the government plans to change its mix of funding.
Yeah.
So the extent to which it's comfortable issuing offshore, the announcement about the first Sukuk bond issue, tapping the Islamic finance market. Also trying to reduce as an aggregate outstanding of nominal government debt, the inflation-linked debt securities, dropping, they would hope, from 35% to a benchmark target of 25%, aiming to put the government's funding mix in a more stable, balanced framework. I think everybody's still digesting that announcement. That's particularly important for pension funds, the inflation-linked market. But no real surprises, as expected, and steady as she goes in an election year. I think maybe that's a good outcome.
Steady as she goes. But before we get into the nitty-gritties of the numbers and what the Minister said, let's look at the initial reaction on the markets. I mean, Colin, you were pointing out to me that we shouldn't be making that linkage between the trajectory that the Rand has taken right now with the budget. Why not?
I think more broadly, carry currencies and emerging market currencies have been very soft this afternoon. So the Australian dollar has been relatively soft, the Turkish lira has been relatively soft, and in fact the dollar is generally quite strong today. On the back of some rather interesting developments in the Chinese currency market, people are speculating as to a potential intervention by the People's Bank of China to try and either squeeze out carry trades or alternatively to try and, ahead of President Obama's visit, try and reinforce a new wave of Chinese renminbi strength. So all of this uncertainty has led to soft equity markets, at least in Europe. And I think currency markets are starting to feel that.
Staying on the global front, Adrian, let's look at the more bigger global factors, quantitative easing being one, sluggish growth in the Eurozone being another. Was this budget a good balance between the pressures from global dynamics and what needs to be achieved domestically?
I think the headwinds that you refer to aren't going away anytime soon because of the structural aspects of the difficulties that face Western Europe, North America, Japan. And those structural difficulties are exactly that. They're structural, which means they're in the architecture, they're well entrenched, and they range from very stretched government debt through to demographic decline. There was specific reference in the budget, and this is unsurprising, to the prospect of sub-Saharan Africa, a recognition that this too now is structural in nature.
Yes.
And you know, there was a time 10, 15 15 years ago where you may have been able to point to 5-6% growth in sub-Saharan Africa and say, well, this is off a low base and we need some convincing. But we're now 15 years into 5% plus, and more than half of the region is growing at faster than 5%. So the reference to the prospect for greater inclusion in economic relationships in the region, I think that was an important aspect, and that will gain elevation as we progress.
You've touched on economic growth numbers. I mean, the figure that we heard today was 2.7 for South Africa, and of course you said NDP, 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 and that's what you kept on hearing at least 53 times. 2.7 against the targets of the NDP. What picture does that paint for you?
Look, it's not enough, and the one issue that I would I suppose take issue with Minister Gordon points to is the 6% growth. I'm not sure that 6% growth in itself is enough. In fact, I'm quite convinced that 6% growth in itself isn't enough. What South Africa needs is inclusive growth, and I would venture that 2% growth with economic inclusion is much healthier than 4% growth, more of the same.
Colin, do you agree with that formula? 2% growth with more inclusion is better than 6% growth against the common trajectory that we're seeing?
I think Adrian's put it really well, to be honest. We know that a huge challenge in South Africa is unemployment, skills level, a lot of the issues that in fact we could call structural in and of itself in South Africa, so independent of the issues that the developed world is facing with its debt overhang. Inclusive growth is extraordinarily difficult to achieve. South Africa is a very strange society, it's quite divided. And we would need, and I think incidentally Adrian mentioned the NDP, that's what the aim of the NDP is to try and integrate the various factions, if you will, that constitute the South African economy so that everybody is able to benefit. I think that's really important for social stability and the extent to which you have this pulling up effect. So I think inequality is a very topical debate. It's come up in the United States, the world's most prosperous, largest economy, most prosperous society, also grappling with these issues. It's a really challenging debate to have, but I think we need to have it, and the choices we face are difficult.
Let's have a very short snippet of that debate. I mean, having a conversation with an analyst yesterday disputing whether tax is an effective instrument to be a redistributive tool. If we were to take that debate further, do you think South Africa is using that tool effectively to redistribute wealth, or what could Pravin have done differently to make it more effective?
It's an interesting question. It's a very political question, so I have to answer very carefully. I think if one looks at the nature of the tax base in South Africa, it's relatively small. If one looks at the nature of the welfare system within South Africa, one could claim that it's relatively broad given the nature of the tax base. I think to that extent we could make the claim that South Africa does indeed have a relatively redistributive tax system, and on the point of inclusion, that perhaps is not a bad thing for social stability, improving living standards, and the minimum wage, if you want to call it that, access to water and so on. Is there room for further tax hikes? I would think very limited from here. We would really be in a situation where South Africa would be an outlier in a bad way compared to other emerging markets should tax rates rise. Of course, the government is in a difficult revenue position, and so it's a very tough question that we'd need to face after the election, post the Davis Commission's recommendations. Okay,
let's move on from that very short political debate. Adrian, let's come back to you and let's look at...
Can we not move on?
Would you want to stay in the politics? Okay,
I'm
sure,
desperate
let's go ahead.
to stay there just for a second. The question that you asked me is really important because it is about the redistributive aspect of South Africa's economic makeup. And as things stand, one way of measuring inequality is the Gini coefficient.
Yes.
And the higher the Gini coefficient, the more unequal your society. South Africa's Gini coefficient sits today somewhere around the mid-60s. And after the influence of tax, we fall to 60, which means even after progressive tax structures, after social welfare spending, our inequality remains amongst the highest in the world. Tax won't solve South Africa's inequality problem. Engagement will.
Tax will save South Africa from its inequality problem, but perhaps let's take a look at what Finance Minister Pravin Gordhan had to say about the budget as it relates to social spending now.
Spending on social assistance has risen from 75 billion rands in 2008-09 to 118 billion rands this year. The number of grant recipients has increased from 13.1 million in 2009 to 15.8 million today.
Well, a few comments there around social spending, but perhaps let's look at some of the issues he raised. I find it particularly interesting, and maybe let me come to you, Colin, with this, that he decided to target the issue of funding for students in tertiary education in light of what we've been seeing with the unrest in different universities and specifically at the Durban Institute of Technology, and saying that there'll be further funding to NSFAS and that they're going to be supporting at least 500,000 students per year. Opportunist or opportunist peripheral issue or a core issue that he had to address today?
I would claim that it's core. I think the NDP addresses education as core to South African social values. We were talking about social stability earlier and the ability of people to almost leapfrog themselves in terms of their own living standards. We've noted, of course, that the government is tackling the youth as a very specific social dynamic with the youth wage subsidy that created some tension with its union allies. And I'm almost certain that the government is exceptionally aware of the high levels of youth unemployment, what this means not only for the economy, but also in particular for social stability. Youth unemployment, even though it's a crisis in South Africa, is a global crisis at the moment, if one looks at what's happening in peripheral Europe, even indeed in the United States. Levels of unemployment amongst the youth are exceptionally high. That leads to social exclusion, and the long-term effects are very difficult. I think it's quite encouraging to see a core focus on education and the impact that can have not only on economic growth in the long term, but also social stability and inclusion.
Very quickly, Adrian, before we go to break, again, we see that figure coming through today, 6 million job opportunities as against employment creation for 6 million people. Did you get a sense that this budget was the right tone for the election manifesto, but more importantly, on the issue of jobs? Did Pravin spend enough time on jobs, and is there enough being done from the budget side to support the jobs drive?
I, along with probably just every other South African, desperately want that 6 million number to materialize as quickly as possible. As things stand, I'm not convinced that we're in the business of building those 6 million jobs. And there's a couple of things. There's much more than just what public sector is able to do. I think it reaches to private sector also, including industrial concentration, amongst other things. So, are the 6 million jobs going to materialize? I desperately want that to be the case. I'm not convinced that we're going to see them.
Welcome back. We continue our 2014 post-budget discussion. Let's take a look now at what Finance Minister Pravin Gordhan had to say about the budget framework.
Despite slower economic growth, the 2013-14 budget deficit is projected to be 4% of GDP, lower than projected in October. The deficit will narrow to 2.8% of GDP over the medium term, and the net debt will stabilize at about 45% of GDP in 2016-17.
So we hear there he's talking about 4% as the target that's been hit for reducing the deficit. Adrian, surely investors should take some comfort in this, given the fact that earlier projections had put it at 4.1%.
Well, I'm not sure the 0.1. Well, perhaps the 0.1 really matters. It's in the right direction.
Yeah.
This is positive. It's not enough for you to be able to sustain your budget deficit. Your economy needs to be growing faster than the size of the deficit. The South African economy grows at 2% roughly last year, and the deficit is 4%, which means the debt is climbing. But the point that the minister makes is that the spending overrun is coming down, and that coupled with growth, we'll be looking at a far tamer and certainly by global standards acceptable budget deficit and debt level in the foreseeable future.
Far tamer being 2.8%. That's the number that he sees it narrowing down to in the medium term. More acceptable number, more in line with international standards? Definitely.
So I think the metric that's bandied about as almost a dividing line is 3%. I think we do have to be wary about the longer term projections. Our own view at RMB is that the government's growth forecasts are a little bit optimistic at the 3.2% level for next calendar and tax year, and indeed the one thereafter. But the broader consolidation phase of government spending is very much on track. So even in the event of growth disappointments, we would expect some measure of consolidation towards that 3% benchmark.
Well, joining us now for this conversation from London is Peter Attard Montalto, emerging markets economist from Nomura International. Peter, thank you so much for making the time to join us. Perhaps let's get your view whether you thought this budget was good for markets and investors.
Well, with the budget deficit basically coming under control, just decreasing very, very slightly versus the MTBPS projections, with the overall amount of issuance coming out in the long end of the local curve set to be slightly lower than the MTBPS. I think from investors' point of view, it's a pretty neutral to marginally positive budget. You then add on top of that the expenditure cap that is still in place. And from the credit agency's point of view as well, I think it should be pretty neutral. But the main thing for us wasn't the numbers, it was basically the rallying cry that Pravin Gordhan has sent out, positioning National Treasury very clearly ahead of the next administration after the election about what he wants to see from the state and from the rest of government. Unfortunately, that may be a losing battle, but he put his marker very firmly in the sand today.
Let's look at the attractiveness of South African bonds right now, Peter, on the back of that budget speech. What do you make of that?
Well, I think, as I said, the amount of issuance was reduced slightly for the long bonds, but what was the problem for investors was actually that there's been a shift in the debt management strategy, which actually basically means that they're trying to shift duration of the local bond portfolio even further out, it seems, reducing the amount of debt that's maturing in 1 or 5 years. So that means the curve should actually steepen slightly more. So I think we're getting to levels after that sort of process has happened within markets pricing now in, where actually South African debt will look quite positive, and we're waiting therefore for more attractive entry levels to recommend people with the current currency level and what's going on in the budget to start buying long end debt in South Africa.
And of course, in addition to the domestic audience, the international audience must have been paying very clear attention or acute attention to this budget, in particular the rating agencies. Peter, your view of how they might react to this particular budget?
Well, I think the key for them and for us as well is basically how the budget took into account a much weaker rand. There's a very significant increases in interest expenditure coming through as a result of the weak rand, but that's been totally offset by decreases in non-interest expenditure and also higher revenues as well, in part given the higher inflation assumptions that they're making and some better revenue collection rates as well. So that's definitely a positive on that front. The negative, if you like, is that even though the amount that's been spent on infrastructure is staying the same, the costs are going up very fast on the infrastructure bill as a result of the weak rand, and they simply can't accommodate that. So the way you do it, it comes out in the budget. It's not explicitly said in the budget, but the implication is that you invest at a slower rate over time. That's clearly not good for growth. It's not good for reform over the medium run. But as I said, that's buried deep within the budget, and the market hasn't really got hold of that point quite yet.
Let's pick up on that, Colin, that point that Peter makes about the weaker rand and the impact that this is going to have on the very ambitious infrastructure project that the government has. Do you think Pravin has taken the right route in dealing with it?
No one's happy. Which probably means it was the right route. I think, as Peter alluded, when everybody's unhappy about a situation, normally means that there might be some sense there. As Peter alluded to, the hidden detail is 5 billion rand in capital expenditure cuts from Eskom. I think, of course, a huge part of Eskom's capital expenditure program relies on imports of specialised equipment, machinery, and indeed skills. I think we know that in the context of slower growth, that may not be a problem in the long term of South Africa's overall generating capacity. However, we do know that, of course, PRASA are about to embark on a multi-year expenditure program renewing South Africa's rolling stock, and at the same time the Ports Authority through Transnet also have capital expenditure that is going to either have to be pushed out or alternatively scaled back.
Right. Let's change track for a second and perhaps turn our attention now to short-term insurer Santam, who has reported a 4% rise in headline earnings per share. Cash generated from operations declined to 1.6 billion rand following increased claims being paid during 2013. Joining me now to discuss this is Santam CEO Ian Kirk. Ian, thank you so much for making the time to join us. Perhaps just to integrate you in the conversation that we've been having about the budget before we get to the results. What was your reaction to Minister Pravin Gordhan's budget? Do you think that he hit the right note with the domestic and international audience?
I think largely yes. Much of it was probably anticipated, but I think he's on the right track. I mean, he's doing the right things. So, yeah, I think largely positive. Should be seen positive locally and by the international market.
Positive and other words that have been used to describe it is firm and sturdy. But perhaps let's look to your results now. 4% increase in headline earnings per share, but revenue or cash down by 1.6 billion rands, Ian. What do you make of these results and what do they reflect about the health of the business?
Yeah, I think the industry is in a tough spot at the moment. It's largely influenced by the weather factors and by the rand, which formed a big part of the discussions in the budget. So on an absolute basis, our underwriting margin is not where we would want it to be. But on a relative basis, we're doing well. We recovered well in the second half. I mean, the big issue is the weather, which hasn't been kind to us, and the rand, as I've said, which impacts primarily the motor account with the increase in repair costs, spare parts.
I'm sure you won't be happy to hear this, Ian, but it is hailing in Johannesburg, so I'm quite certain that's going to have an impact on business. But perhaps let's talk about your underwriting margins. I mean, from your trading update last year, you had indicated there that you were below the target of between 5 and 7%. Have you made any inroads towards that target?
Yes, I think we did. The second quarter was better than the first quarter. We were really hard hit. Third quarter, better again. In the fourth quarter, November was a very difficult period for us. As you know, there were major hailstorms events in Gauteng. We had big flooding in the Western Cape. Incidentally, that one event on the 28th of November was the largest single event in SA, cost the industry in excess of 1.6 billion. So November was difficult. December we did a bit better. So, I mean, we're doing the right things, but the weather is difficult to deal with.
Of course, as the landscape also gets quite competitive, Ian, we're seeing consumers who are under pressure shopping around for better rates, and I'm seeing a lot of noddings at the desk here. What are you doing differently to ensure that you're able to balance the need to keep your market share and your clients and attract new clients at a time when consumers are under pressure and are shopping around?
I think it's a very good question. It's something we watch very carefully. If you get a 40% slide in the value of the rand, that translates into significant pressure on premiums. Largely related to the motor parts. So what you do is I think what other businesses do. You push back into the supply chain, you take pressure on your own margins, and you take a view as to what the consumer can bear. And then you encourage your consumer through the brokers to manage their risks better. So if we arrive at a certain average rate increase that we think is affordable and appropriate, you tend to give your better risks a reduction off that, an increase nevertheless, but a reduction off the base. And then the poorer risks incur a premium increase over and above that. So we know how to do it. We've done it that way for many years. It's difficult with the significance of the slide in the rand. I mean, we don't like the volatility. It doesn't work for us, as for other industries. But it's a case of recovering over a period of time. The consumer is under pressure. We recognize that. We need to be there for our consumers.
Ian, let's talk Africa. The story of insurers expanding into Africa is becoming commonplace now here in South Africa. Let's talk about your activities on the continent together with Santam. How are those translating for your bottom line?
Well, quite nicely, actually. In the first 6 months, we brought through some income from our business from India. We cemented the relationship with Santam in December. We did quite a large transaction there. We sold our investments in general insurance across to them. We took 35% of their general insurance investments, retaining 35% of our own, and committing 35% of their future general insurance investments. And that really is, coordinated the process quite nicely. We see a lot of opportunity. There are some markets are bigger opportunity than others.
Which markets, Ian? Which markets are exciting for you right now?
Well, the ones India, we've done very well in general insurance since 2008. I'm so proud of how they've done there. Nigeria's a new market for us. We've just started there. Big opportunity. It will take time. Malaysia, I think there's some nice opportunities. And also, I think in East Africa, Kenya is sort of be the center, but also Uganda, Tanzania, Rwanda. That's an interesting market opportunity. This will take time. It's not going to be an overnight thing. But over 3 to 5 years, even through the 10-year scenario, it's making a difference to Santam already, quite a substantial difference. And I think we would hope to make a similar difference at the Santam level.
Let's come back to South Africa and let's talk about your decision to consolidate office spaces with Santam. Why did you decide to do that, and how does that translate into better product and service for your consumers?
Service level, certainly, but it's a cost-driven thing. It just doesn't make sense for us to be in different locations in the same towns. We're in 68 locations, they're in 97 locations. We started this process a number of years ago. In the rural areas, it was a bit easier than the major metros. We're now doing, as you've indicated, we're now doing Santam together with them. It's just a logical process. It's a cost efficiency driven thing. Not really around service. We have our own brand, we have our own insurance. Short term is not the same as life.
Very quickly, Ian, just before I let you go, what can we expect from Santam in terms of doing things differently to ensure that you're able to turn the corner irrespective of the weather?
Well, I think we've got to assume the worst on the weather front, particularly with the Gauteng area and hail. So we're going to have to introduce geographically segmented rate increases around the weather. We're going to have to be very smart in dealing with the rand and the effect on the car parts. We're going to continue to apply our segmented, risk-adjusted rate increases to get back to our target margins. But we need to be cognizant of the situation the consumer finds itself on the retail side, also on the commercial side, obviously, which is the most important profit contributor for us. So I think we know what we're doing. We're doing it responsibly. On a relative basis, we're in strong situation. And of course, what happens in difficult conditions, opportunities arise, and that can play into our hands as well. So it's tough, but we look at it positively.
Come back as we continue our post-2014 budget discussion. Let's take a quick look now at the measures to promote economic growth from the Finance Minister.
Manufacturing development initiatives are allocated 10.3 billion rands over the next 3 years, in addition to tax relief offered through various incentive programs. The economic competitiveness and support programs will provide 15.2 billion rands to businesses to upgrade machinery and increase productivity over the MTEF period.
Peter, let's come back to you on some of those initiatives that the Minister has noted to improve economic growth and to stimulate the economy. But in particular, I want to talk about his push to relax the regulations as they pertain to exchange controls. Again, this being something that the international investment community should react positively. Do you think that it's sufficient, the advances that he's making?
Well, I think on the manufacturing incentives, these really are fiddling around the edges. I mean, they make no difference when we start considering like what the potential growth rate of South Africa actually is, and there are far bigger constraining factors on potential growth, like labour laws. So I think we don't really read that much into those issues. And on the exchange control factors, I mean, these aren't really issues that affect international investors or FDI. What they hopefully will do in parallel to the increased incentives for tax-free savings domestically should be to create a larger pool of money available for South African banks to give forward in credit or into investment in the economy over the medium run. So they're marginally positive, but I don't really think the foreign investors are looking that much at those issues.
A rather somber response from Peter Adrian on those exchange controls and tax incentives for manufacturers. Do you share the same sentiment?
I think on the foreign exchange controls, it's just sort of steady as she goes, and for most South Africans, foreign exchange controls don't apply. They're simply not an issue. What I would look for here is stability, clarity, certainty, and absolutely unambiguous positions on the policy. And I have a good sense that we're on the same path, and I take that as a clear positive. Peter's response on the manufacturing sector, I agree. You could drop tax rates to zero, and I don't think that miraculously transforms South Africa's competitiveness. The two big lags in the manufacturing cluster are labour productivity and total factor productivity. Labour productivity comes from on-the-job training, cumulative work hours, and total factor productivity comes from infrastructural support, and it includes the removal of red tape. I think rather than adding more money to the pot, take some of the red tape away.
Before I come back to the labour issue, which I want to pick up with you, Peter, perhaps let me come to you, Colin, first. And I want to pick up on intra-Africa trade. Again, we saw a lot of talk about infrastructure and boosting infrastructure, and also around intra-Africa trade, tax and policy incentives to ease the cost of doing business on the continent. Do you think that this again is an attempt to reinforce South Africa as the gateway into Africa, as it seems as if we're losing out to East Africa at a very rapid rate on that one?
Absolutely. I think you hit the nail on the head. So using South Africa as a base, in particular for large multinationals who wish to set up wholly owned subsidiaries here and incorporate in South Africa, and indeed for South African corporations, the CEO of Santam mentioning that they're keen to expand in Africa. Announcements today on that front. The amount has been raised from 750 million rand to 2 billion rand that corporates would be allowed to export, if you will, to Africa without prior approval from the South African Reserve Bank's Exchange Control Department. Again, highlighting the hub effect, if you will, and more importantly, the belief that the South African government has that its longer term future is tied to a successful integration into a successfully developing African economy, as Adrian and Peter have mentioned, broadly in line with the policy to gradually relax and remove exchange controls, and slightly encouraging in an environment where the rand has been exceptionally weak, in part on the back of large financial portfolio outflows, of course, over the last 3 to 4 months.
Peter, did the minister do enough to re-inject confidence in the labour sector in South Africa?
Well, not at all. I think he has very little control over that kind of area of policy in government. We saw, I think it was about a year ago, when he did speak out on labour issues more forthrightly, he was slapped down by Zuma. So I don't really think there was anything here that could reassure. The labour story in South Africa has its own dynamic, is undergoing structural changes because of what's going on within COSATU, within the tripartite alliance as well. So I'm not really sure that he had any ability to do anything today, and didn't really deliver on that either.
So would you say that this is not necessarily an opportunity missed for the minister because he really didn't have room to maneuver?
Yeah, I think that's probably fair enough. But I think there were wider, positive sort of, emotions to come out of the budget speech, particularly around positioning of NDP, things like that. But this really is an internal argument, if you like, within the ANC and within government that Pravin Gordhan used today. It wasn't about us on the outside, it was him making the cry within government that we need to stick to these more conservative, market-friendly policies, and that unfortunately I don't think will 100% be followed by a new administration after the election, but he's trying to make that stand now.
Well, back home, the rumor mill has it that Tito Mboweni, Adrian, is the man that is likely to succeed Pravin Gordhan. What do you make of that? And if Tito was to come on board, do you think there would be a positive or negative reaction by the markets?
Shall I just smile?
No, that's my job.
That rumour's been in the air for a little while now, and it wouldn't surprise me if that transpires. He's highly regarded inside the party, the ANC. He's highly regarded outside of the party. He did a superb job, I think, as the head of the central bank in South Africa. Comes with a great reputation. I think would be positively received internally and externally.
I'm going to try and ask this, Colin, in as much as I can to take out the politics out of it, but is Tito the man for the job?
I think he's certainly got a lot of experience in financial and economic matters as they pertain to South Africa and the current challenges the global economy is facing in light of monetary accommodation removal. I would perhaps potentially disagree with Adrian's comment about the ANC's liking of Tito Mboweni. I think he's quite a divisive figure within the ANC, noting that, of course, the ANC is indeed a very divided and a diverse organisation. So, for example, segments of the Labour Federation were exceptionally unhappy with the policies that he pursued at the Reserve Bank. And to that extent, not everybody within the alliance would welcome him. However, certainly a credible and experienced figure, and certainly it would be interesting to see whether, in light of recent political changes within COSATU, President Zuma is willing to take the political risk.
Well, that does conclude this segment of our special edition of the 2014 Budget Day coverage. Thank you to our panel, Adrian Saville, Chief Investment Officer and Founder at Cannon Asset Managers, Colin Wakefield, Derivatives Specialist at RMB, and Peter Attard Mongtalto, Emerging Markets Economist from Nomura International. Gentlemen, thank you.